All right. This is market update for December 2, 2022. First things first, we are no longer in the death cross. The 50-day has moved above the 200-day, and typically that is a bullish sign. It means that the market is turning up, and that is true. Let's take a look at the sectors here. So basic materials. Get rid of this one. Basic materials, no one above their 200-day, but 8% above their 50-day. So again, not a great sector, but it's getting better. All right, telecommunications, again, 0 above their 200-day, but a whopping 38% above their 50-day, which is 83% better than the rest of the market. And this is a sector that was doing so poorly on last month and now has really come back. Consumer cyclical sector, doing really well, which is why I hate that we're not in that sector right now. But it is what it is. 17% of those companies above their 200-day, 17% above their 50-day. And what this tells me is that these companies are doing way better than what they did do last year, but not doing as well as some of the other sectors currently over the last month or two. I imagine that this is going to continue, being that they aren't doing as well as the other sectors. Something tells me that that's going to change. All right, consumer defensive, 9% above their 200, 9% above their 50. Kind of in the same vein with consumer cyclical sector, of course, not doing as well, but definitely better than some of the other sectors that we've seen so far. All right, energy has been a high flying sector for quite some time now, 21% above their 200-day, which is 200% better than the rest of the market. However, none of these guys are above their 50-day. And that just goes to show that the energy sector has really cooled off quite a bit over the last month or two. All right, the financial sector. This one is just, I don't know, it's been crazy. It's been crazy. 3% above their 200-day, 13% above their 50-day, which is not the worst performing sector, but definitely not the best. All right, and then the health sector, which has been a real surprise, I think, for a lot of people, that really isn't getting a lot of press, but 14% above their 200-day and then 14% above their 50-day, which, again, isn't awesome, but, again, one of the better sectors right now in the economy and in the market. All right, the industrial sector. None of these guys are above their 200-day, 30% above their 50-day. So not doing as well as they have done in the past, but definitely doing a lot better over the last few months. All right, real estate is another sector that we spend a lot of time looking at because it's our largest holding right now. 5% above their 200-day. Again, not awesome, but not horrible. However, 30% above their 50-day. So doing much better than some of the other sectors in the market right now. Technology has been a real dog, I think, over the last probably 3 or 4 months now. I think a lot of this has to do with the China reopening and the news surrounding that. Also, impending recession, people not spending as much money on new computers and new phones and things of that nature. So not doing great right now, but we do know that when the economy is doing good, the tech sector usually does well. And so I'm looking at this tech sector as being a leading indicator of showing exactly what's happening right now and where market sentiment is. And right now, the future is not looking super bright, but it doesn't mean that everything is all bad either, right? It just means that, we don't see a lot of extra money being spent on these electronics and luxury type items. Our utility sector, which has really done really, really well overall, and for us specifically. 4% above their 200-day, again, not awesome, but better than some of the other sectors. A full 54% above their 50-day. So again, utility sector, you know, the utility sector, typically consumer defensive companies, typically your basic materials, are all going to do really well in an environment where you don't have a lot of additional money being spent on luxury and things like that, because these are sectors where people have to spend money. They don't have a choice, right? And we know that utility companies are basically mandated by the government with how much money they can make. And so there's a very good chance that a lot of the investor money is being poured into these companies right now, specifically, like I said, the utility sector, because their money is pretty much guaranteed. All right, let's take a look at the individual companies now. So sector MVP in utilities, WEC. We are currently in ETR, which is down here at the bottom. Looking at the performance, 1% a month is not the best, but somewhere around the top compared with the rest of these guys. This one is strange. I forget the name of this company, but yeah, so negative 1% compared to everyone else actually showing a gain is definitely troubling. ATO, so really kind of WEC is no doubt the sector MVP. The rest of these guys is really split. And again, that simply means that pretty much any company you pick in the utility sector is going to perform about the same. You know, maybe this WEC is a bit better performance-wise, but when you look at the numbers, you know, 0.83 compared to the 2% that we see here is not, you know, the best, but not the worst either. All right, technology. Corning, again, sector-leading MVP. I think that's been the case for quite some time. Even the performance is really sort of in line with everything else. IBM has been a sector-leading performer for a few months now, and I'm not quite sure why that is, honestly. I think their manufacturing maybe is done in the U.S. I'm not certain, but maybe that has something to do with it. But everyone else in the sector looks like they're losing money month over month. Looks like Intel is the worst of the bunch, followed by Qualcomm. So I'm definitely happy with our holding in Corning as the sector leading MVP, far outweighing the rest of these guys in the sector. All right, real estate. Looks like KIM and MPW share the sector MVP there. But looks like KIM, WPC, Williams Carey, VTR are the only positives in the group right now. And, you know, when we look at, you know, 30% of these guys being above their 50-day, you know, that tells me that this sector has really bounced back over the last 30 days. And you can see it here, right? A 9% jump there, 18% jump for MPW, but then you have a 19% drop in October. So really even, but this last month has really been really great for the real estate sector. All these guys over the last 30 days are above, you know, 5%, which that's a really nice jump, with the exception of BXP for some reason, which I think is the worst performing company in the group. So my thoughts on this are, if everyone else in the real estate sector seems to be doing really well over this last 30 days, but BXP is not, the question is, what is BXP doing? What is their business? Because maybe that's the section of the real estate sector that you want to stay away from, right? I imagine some of this has to do with the new interest rate talks. They only went up 0.5% versus something higher. So maybe once we start seeing interest rates come down further, everyone in the real estate sector is going to get a boost. We'll see. We'll see what happens. All right, industrials. All right, so again, really spread out as far as the sector leading MVP, meaning that any one of these guys you choose is going to perform about the same. Looks like Raytheon, CHRW, SWK, IRM, Triple M, 3M rather, all on that list. Paychex is where we are, 0.72 a month return. So it is positive, but it's definitely not at the top. I'll say top 5 maybe. So not horrible. Raytheon, being that we are at war, is definitely the winner in the group, no question about it. All right, healthcare. Pfizer, sector leading MVP. That's been the case for a long time. Cardinal Health, sector leading performer, which I think has been the case for a while now. And then Merck is right there with 4%. Again, this healthcare sector has really surprised me. They kind of really came out of nowhere and just really started performing. I mean, look at these numbers over the last 2 months, 6 and 8, 10 and 7, 13 and 10, 9 and 4, 11 and 7. I mean, this is where the money is being made, right? Now, the question is this because the healthcare sector is doing something different than before? Or is it just because people are seeing these as safe bets? And so that's why all the investor money is being poured into these companies. I think it's the latter. Same thing with utilities. All right, financial services. All right, here we go. Again, sector leading MVP, really kind of spread out. Any one of these guys is probably going to perform about the same. It is true, however, I talked about this before. In this financial sector, you have insurance, you have what's called big money banks, and then you have regional banks. And so I think the difference in the price performance has to do with the type of bank it is, right? So PFG, AFL, MetLife, Allstate, these are going to be insurance companies, and insurance companies do really well when interest rates go up, right? Regions Financial is where we are down here at 0.41. Still positive, but not great. I am happy though that we are not in these big money banks like JP Morgan or Blackstone, which Blackstone has been a sector leading performer for a very long time. But right now, because you have so much money coming out of banks and being spent on other things, people aren't investing so much in the stock market. They aren't investing as much into 401ks and things of that nature. When you think about the fact that they're raising interest rates for the purpose of trying to cool employment, right? They actually want to see unemployment. And so that means that you don't have as many workers putting money into these 401ks and these retirement plans. And so these big money banks like Blackstone, JP Morgan, Bank of America, and those types are not going to do as well in this environment. Not until, anyway, we have a full swing and we go back to, excitement around new jobs, excitement around a roaring stock market, right? I do expect that the regional banks are going to do a bit better than the big money banks, which they are. And then, of course, the insurance companies are going to do much better than all those guys put together until we start to see interest rates start to drop off. And then we'll start to see those insurance companies not perform as well as they are now, right? Not to say that they won't perform well, they just won't perform as well as they are now. All right, energy sector. MPC, sector leading MVP, I think we can call that. 586 return. Again, the energy sector has been on fire for a long time now, better than 200% of the market. That's double what the rest of the market is doing right now. I mean, you look at these returns, 5%. This is where the money is being made. 5% a month. That's a month. That's what, 60, almost 50% a year. So this is where the money is being made. Huge dividends for a lot of these companies. And so I imagine a lot of money is being poured into these companies, not only because It is a stable income, not only because we're at war with an actual oil producer, um, but also too because they have these large dividends. And so people are putting money into these companies to reap those dividends in a market that, you're not going to get a lot on price appreciation. We're currently in ENB 0.85. This particular company specifically has a very low risk rating. And so that was done on purpose. And so if you can imagine, the one company with the lowest risk rating in the energy sector does not have the largest return, which is fine. That also means that it won't lose as much money either. Maybe that's not always great in a time where the energy sector is booming, but it makes sure that if something does happen with the energy sector now or in the near future, we won't be caught up in that. All right, consumer defensive. All right, Walgreens, sector leading MVP, really spread out though amongst the group here. Coca-Cola is where we are, 1.74 return, which is not at the top, but near the top. So not doing bad at all. Again, over the last month, we have some really nice 15, 9, 6, 13, 8, 3. So this last month has been really good for the market. Last 2 months, really, specifically with the consumer defensive sector. And I don't expect that to change. I think that all of these companies have gotten the whole inflation thing and cost thing under control. And so now they're just, they're already talked about pricing. They've already increased their prices. And now I think as we see inflation cooling, I think that it's only going to bode well for these companies, because it's not like they're going to drop their prices after this stuff cools, right? Those prices are going to stay just as high as they are now, and their costs are going to start dropping, and we're going to see some really big profits, I'm sure, in the next 6 months. All right, consumer cyclical. All right, IPG, sector leading MVP. The rest of these guys are really spread out. It looks like also too, the performance is really wild in this sector. Again, the consumer cyclical sector is typically a sector that you do want to stay away from when there is talk about inflation, recession, unemployment, and all this kind of stuff, because these are the companies like Hasbro, Starbucks, right? Best Buy. These are the companies that people are going to spend money on for like gifts and like luxury items, not necessarily things that you definitely need, right? And so we see Genuine Parts Company, GPC, far beating out the rest of these guys. And the reason why is because even though Genuine Parts Company is listed as a consumer cyclical company, it really is way more defensive, because we're talking about auto parts, used auto parts, right? And so when the economy is doing really well, it is a consumer cyclical company, because you have a lot of guys working on like old cars, right? But in a time when the economy is not doing so great, you have persons that aren't buying new cars, and so they have to buy parts for old cars because they're not buying. They're keeping their old cars longer, right? And so that's why I love this company in this environment. That's the reason why I believe this company is doing as great as it's doing. Unfortunately, because it's doing so great, the stock price is just too high for us to buy into it. But still looking at it, and hopefully maybe if the price comes down, we'll be able to get in. If not, maybe we'll look to get in somewhere else. I mean, right now, I think this IPG, sector leading MVP is something to maybe look at. We do have this OMC, which is not really a sector MVP, but the performance is okay. So we have a couple options, and we'll definitely look at those. All right, communication services. Lumen has been sector leading MVP for a long time now. However, the price performance is horrible. Now, why is it that a company with such horrible price performance shows up in the best performing portfolio every month? I'm not sure. I'm not sure. I don't. I imagine that this particular company, Lumen, happens to be involved in portfolios where the communication services companies are listed towards the bottom of the portfolio. Because remember, companies listed at the top of the portfolio have a larger weighting, right? So the first company gets more shares. The second company gets a little less, third company a little less, and then you get to the bottom, which is the 11th company, gets the least number of shares allocated to it, right? And so I think maybe what's happening is this company, Lumen, has the least number of shares allocated to it. I don't know. I can't call it. I can't call it, but definitely interested into looking at those portfolios and seeing why this is happening. Either way, the only company that even has a positive return right now is Rogers. And you know, this has been a long-term holding for us. I really like this company because unlike the rest of these guys in this sector, Rogers owns sports teams. And so you're talking about baseball, basketball, and hockey. And so on top of, you know, the typical telephone utility thing, they're also getting ticket sales. They're also getting advertising deals and all these other things. So really happy with our position in Rogers. Not a sector leading MVP, however, but by far the best price performer over the last 12 months, which hasn't always been the case, you know. But over the last 12 months, they're definitely the best performance as far as price. Okay, basic materials, again, really spread out, really not an MVP to speak of. This SLVM, I think I'm sure I've talked about this before. Can't really say much about this. It's a brand new company, just entered the market. And so a lot of this, the return that you see here is just going to be excitement over a new IPO. You know, doesn't really mean the company is doing any better or any worse than anyone else. Just people put money into new companies before they do old ones a lot of times. So the rest of these guys, though, CTRA, FMC, definitely sector leading performers. So we're currently in Southern Copper, which again isn't the best, but definitely near the top compared with the rest of these guys. And so looking at the last 30 days, again, the market just went crazy the last 30 days. And we see these outsized gains of 20%, 15%. And again, I'm certain that this has everything to do with the fact that interest rates were raised, but they weren't raised as high as they have been. And so that is a leading indicator that inflation is cooling and that at some point we will cease to tighten the reins on the economy and we will let money freely flow again. And then all that freely flowing money can find its way into the stock market and improve prices. All right, let's take a look at our heat map here. Actually, no. Take a look at the portfolio. Yeah, so this was the biggest thing I saw when I did this. This was really interesting. So I talked last month about possibly a change in the market, right? For the last probably 6 months, the standard deviation portfolio has been the top performer. And that's the reason why we're following the standard deviation portfolio, because it has been the top performer over the last 6 months, over the last 12 months, 6 months ago. Currently, however, over the last few months, I've noticed that particularly the up and down portfolio and then this alpha portfolio has slowly been working its way to the top. And now standard deviation is You know, still top five, but definitely not as high as it has been. And we see all these alphas. Look at all these alphas, all those alphas. And so alpha simply means that when the market is doing well, these companies do better, right? When the market is doing well, these companies do better. And then up and down is kind of a play on um, standard deviation, but maybe also a little bit of alpha. It's a different thing. You know, again, when there's a lot of volume, when there's a lot of buying and selling, these companies tend to go up in price relative to everyone else. But also too, when there's a lot of buying and selling, these companies tend to go down in price, less than everyone else. And so again, it is something like a standard deviation, but it's a little something extra, right? And so that one right now is doing the best, and it has been, like I said, slowly coming up and up and up in the portfolio. So it's currently at 13%. That's since July 2021. The last 12 months, this is not including any dividends, mind you. This is just price appreciation. And we see, again, the up and down portfolio and then all these alphas. Look at this. And then return up, alpha again. And standard deviation is working its way down to the bottom. So the question here is that when or if we do decide to replace something like a Merck, replace something like an EMB, right? Do we replace them with companies that are scoring in this up, down, or alpha score, or do we stick with our standard deviation, right? You know, the problem with alphas are that, and I can show you here, the problem with alphas is that when it's bad, it's really bad, right? When it's good, it's really good. When it's bad, it's really bad. So this is statistically the lowest loss, or the largest loss, I'll say, that this particular portfolio can have, right? So again, we see alpha. Now, it is different alpha portfolios, but they're still alpha portfolios, right? And so you can potentially lose almost 14% in 1 month with these portfolios, right? Let's look at the highest return statistically in a month. And again, we come to the dividend alpha portfolio, right? And these are a bunch of betas because I think I've talked about this before. Right now, I don't think it's a good idea to bet against this market. I mean, if you look over here at this beta return, since July 2021, this portfolio has lost 17%. Over the last 12 months, this portfolio has lost 25%, right? But when the market is not doing well, this thing can return 11% in 1 month. So it's about trying to time the market, trying to pick out when the market is going to drop. That's when you want to be in these names. This is not a set it and forget it type of portfolio right now, right? If you want to trade, if you want to get in and get out, you can definitely make a lot of money using some of these names in these beta portfolios. But if you're investing and you want to keep your money in there for a while, it's not a good bet. Not a good bet at all. You know, you're losing money. No question about it. And I just want to go down to, well, let's do this. Let's see the smallest return statistically. And there we go, standard deviation, right? And this goes back to what I was saying in the previous video with our current portfolio, which is right now, our standard deviation, our risk profile is very low. It's only 1%. Historically, it's been 2%. Over the last 3 years, it's been, close to 2% over the last 3 years. Over the last 7 years, it's been 2%. So it's half of what it has been. And so we definitely want to see that increase. But in order to see that increase, we're going to have to take on more risk, right? We've got to take on more risk. And so the question again is do we take on more risk now, or do we wait to see how this thing plays out? So that's going to be a question when we're looking at some of these other companies, and I think I'll do that today as well. So anyway, and then this is interesting too. So the dividend beta down, which is companies with a high dividend who perform well when the market's not performing well, and they tend to move down. So it's a very defensive portfolio, and these companies aren't moving around as much, which is interesting. It's just interesting. I mean, typically standard deviation is almost always the top of that list. You see STD here, STD there, STD there. So M score, we talked about that one. But then you see the dividend there as well. So I think that says something to, again, what's happening in the market. I think that people are putting money into these high yielding dividend companies as a defensive move, as a safe bet. And because of that, maybe those prices aren't moving around as much, meaning that maybe the money is going in and not coming out. People are just parking the money there and just leaving it there, kind of like a savings account, right? So they're not selling their positions for profit. They're just putting the money there and letting it sit there to collect dividends. So I can definitely see that being the case, especially with what we know about the utility sector and those types of things. All right, let's take a look now at the heat map. Well, actually, no. What I want to do is take a look at the alpha portfolio and see what's in there, and then maybe see if we can find Lumen. Well, there's Lumen right here in the dividend portfolio. Okay, so that's what's happening. See, so Lumen has the highest dividend in the communications sector. That's what's happening. That's what's happening. And so what's happening is the price is going down. The stock price is actually losing money. But as the stock price loses money, the dividend yield keeps going up. And so I don't know. I don't know. It's a strange thing, you know. Maybe this means that the Lumen stock has found a floor, meaning that it has gone down as low as it could possibly go. That's definitely something I like to do fundamental analysis on to see if, you know, the stock price is maybe below what the company is actually worth. That's possible, you know, and if that's the case, then man, you can buy this company and just sit back and collect those dividends and watch the price go up and up, because at some point, you know, common sense is going to have to come into play, right? All right, let's take a look at this alpha. All right, here we go. So these are all the high flying, huge returns, big money companies here. MPC Energy, we know that one. When the energy sector is doing well, this thing is going to fly. I think MPC deals a lot with leverage, basically, meaning that they get these loans and they use the money from the loans to invest in oil wells and all this sort of thing. And so when the oil price is decent, then they can easily just print money, right? But when the oil price drops, they lose a lot of money because they still have to pay back those loans, but they aren't making as much with the oil they're producing. All right, CG, don't know much about these guys, but looking at the price performance though, it was 46 and currently it's 27. So not doing any favors for this portfolio at all. Corning, really happy to see Corning in here. So that means that we have the highest alpha company in the technology sector in our portfolio. So that's really good to see. KIM, real estate, hasn't gone anywhere. That says a lot. We know that they are co-MVPs with MPW. Okay, and then MAS, I know a lot about these guys. Looks like they've lost a little bit here. Best Buy, Consumer Cyclical. We know that they have not been doing well. KDP, I don't know anything about those guys. They pretty much stayed the same. And then SWK, the industrial, losing more than half its value over the last 18 months or so, is huge. And then Cardinal Health, we see it's done really well. Again, all of the healthcare companies are doing really well right now. PARA in the communication services sector has lost, again, more than half its value. And then DTE in the utilities has not gone anywhere. Again, that is definitely what the utility sector has done. So, you know, looking at this portfolio as it is, it appears that the only thing that has given this portfolio any sort of gains or performance has been in the energy sector. And again, we do know that the energy sector has been high flying for a long time. And when you talk about doubling the largest holding for this company, of course, those returns are going to be awesome. So you see this total return here of almost 7%, a dividend of 7%, because again, those energy companies pay a large dividend. So I imagine MPC is throwing off a nice dividend for them as well. And yeah, I mean, it's amazing to think that even with like horrible performance from something like a Best Buy, because there's only 4 shares of Best Buy versus 17 shares of MPC, you know, this Alpha portfolio is doing really well, almost the best in the market. Let's go back. So see, there's your 7% right there. All right, so let's look at the up and down portfolio. Where is it? Where is it? There we go. All right. So again, we see MPC there. So again, I'm certain, and it's at the top too. So I'm certain this is the company that has seen those outsized gains that's really pushing the return for this particular portfolio. AEM has lost a little bit. Corning again in this portfolio is really good to see. Has lost a little bit. Lumen somehow made it into this portfolio. Has lost has lost half its value. KIM again, very steady, hasn't gone anywhere. IPG fairly steady, specifically for a consumer cyclical company, has not gone anywhere at all. The other thing that's interesting here is the dividend is $16. Wow. 16 there. I'm not sure about that. I'm not sure about that. I wanna check that out. IPG. So okay, current price $28. The dividend is it still doesn't give it to me. So it's just half. Let's see. Okay, so yeah, the annual dividend is only 3.5%. So, so that may be a problem. Let's see. How do you get 16 here? MA6, some cyclical. 29 cents. Yeah, that's right. 7. Okay, okay. I know what's going on. All right. So yeah, this is not supposed to be a dollar. It's also not. I'm gonna have to fix that. Anyway, so the dividend is not $16 at all. But I do have it correct in here. Okay, so PFG, okay, insurance. So yeah, for sure, that one's definitely got a nice jump. CHRW, pretty much even. TSN, haven't seen that one in the consumer defensive. That one's down a little bit. Then WEC, again, utility hasn't gone anywhere. So I'm really happy with our utility because we've actually had a nice game with our utility. The rest of these guys haven't really gone anywhere. Pfizer, again, healthcare, doing really well. So I will definitely now, again, going back to what we can actually replace in our portfolio right now, right? Um, the basic materials, I think Southern Copper is doing better than these guys just based on these numbers, right? Um, the other one to replace is the utility, but again, our utility is, you know, pretty much staying the same or 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 going higher. So I think the consumer cyclical, something like an IPG, I think it would be a nice um, substitution for GPC. You know, it's not as good as GPC, but at least we can afford it, right? Because we can't afford GPC right now at more than $150 a share. And let me just check real quick and see where it is. See if it's come down any. Yeah, GPC is $175 a share. Can't do it. So, but just to imagine, we almost got into GPC at 150, and you know, talking about $26 profit. My goodness, we missed that boat. All right, let's see some other ones here. Alpha up and alpha down. I think it's interesting. Um, yeah, let's take a look at alpha up. Let me find it. All right, well, gotta be somewhere. Alpha standard deviation, alpha down. There we go. Alpha up. All right. Again, MPC. Yeah. So MPC, I think, is the company that has thrust all of these alpha portfolios into the lead right now. So I don't think it's so much the portfolio. I don't think it's really so much a market change. Um, it's just the energy sector specifically, I think, has really, um, like I said, it's where the money's being made. That's where the money's being made. Um, all of those alpha return companies specifically in the energy sector is where the money's being made. KIM again, in the better performing portfolio. Hasn't moved around much at all. PPG, basic materials, lost quite a bit. Corning in there again. IVZ, which is, I forget IVZ, I think it's a bank, but I want to say it's an insurance company. Let me double check. Curious. Okay, yeah. So it's big money bank. They're doing income investments and whatnot. All right. So that's why. So yeah, lost almost half its value. PARA again lost half its value. Pfizer, we know healthcare is doing fairly well. IPG in this thing again, not bad for consumer cyclical. TSN again in the consumer defensive, has lost a little bit, but not a crazy amount. EMR for industrials, I'm gonna say it's it's down 10% roughly, so not horrible, but not great. And then DTE again, utility. And again, like I said, I think with all these utilities, pretty much whatever you pick, it's going to be about the same performance. I don't think there's going to be any portfolios that are like, oh yeah, utility at the very top. We want as much of that as possible. I don't see that happening. Um, let's check. Let's check the. Let me see. We got up, down. We got alpha up. Let's check the. Well, we know the return is not doing great at all. So let's go with the M score is kind of always in there somewhere. Let's check let's check the up moves. Let's check the up moves and then maybe the down moves just to see if there's going to be any difference at all, or are we still looking at basically the energy sector coming in and being the hero here? Maybe if I try my let's see. What? Oh, round down. That's not gonna work. All right. Wow. Yeah, wouldn't expect that. So Hasbro is at the top of the list in the consumer cyclical, and as we know, the consumer cyclical sector has not done very well at all this year. So lost a lot there. MAS lost a lot there. NWL lost a lot there. Cheniere Energy, there you go, 36 to 60. So again, the energy sector is where all the money's being made. STT has not lost a lot, but definitely lost some. QCOM lost quite a bit. CVS, again, healthcare sector doing really well right now. Again, utilities hasn't gone anywhere. THRW lost a little bit. KIM again, and then Lumen again. I don't know. I don't know. I guess it's just the dividend. It's got to be the dividend. Um, Lumen just for whatever reason finds itself in all of these defensive type of portfolios, and I think it's because of the dividend. I think people are just putting their money there, just parking it. Um, but the price performance has been horrible. So I don't know. Like I said, maybe Lumen is finding a floor. Maybe the stock price is as low as it can possibly get, and so that's why people are just pouring money into it. Or maybe it's one of those situations where people are just trying to make money on the yield and they don't care about the stock price losing so much value. It's very hard for me to believe that, but Anything is possible. All right, let's take a quick look at the heat map just to see if there is any like visual difference that we can pick out. Automatically, I look at the alpha portfolio there, and it doesn't look great with these reds in there. But standard deviation, there's absolutely no bright reds. There's one here that's kind of red, but the rest of these are nice and green. And then we see some deep dark reds in a lot of these. Lots of reds in the beta alpha. That's to be expected. Lots of reds in these. Cherry reds in these. Oh my goodness, these are horrible. All these are horrible. And this is again those beta portfolios. You can't bet against this market. You can try to time it, but not bet against it. So this one doesn't look bad. And well, two dark reds. It's not great. But the reason why I say it doesn't look bad is just because it appears that almost everything lost in these 2 months. There's just this red strip going straight across for almost every portfolio. Until you get here with the up down and the standard deviation for sure. But yeah, I'm happy where we are. I definitely like the fact that the standard deviation, even though it's low risk, meaning that we're not going to have any huge gains, we're definitely not going to lose as much as the rest of these portfolios are losing when the market does drop, right? So definitely going to stick with the standard deviation, meaning that those companies that we do have a gain in, probably not going to move from there. Take a look at what the portfolio looks like. So Tullus is the company in the communication sector. Maybe, possibly, if we are able to sell out of Rogers, we get into Tullus. It's another Canadian telecommunications company that I've followed for quite some time. CM is a Canadian bank. I want to make sure I'm right about that. Yeah, Bank of Canada is something of a regional bank up in Canada. Coca-Cola is where we are. We're in Merck and not Pfizer, but I'm happy with that because Merck has a larger dividend than Pfizer, and I think both of these guys are performing just as well. Utility, again, I think we stay where we are. I think it doesn't really matter. IBM has done much better than any other tech company in the sector. I'm not sure as to why, but I'm definitely going to look into it and see what's going on there. Corning is at the top of a lot of those alpha portfolios, which I'm happy with because at some point we are going to want to see those outsized gains. And I think that Corning is going to be the one to take us there. Specifically, not just with the statistics, but also with their business strategy, their portfolio of products and all that. ENB is where we are. Energy. So just, hasn't done great, but hasn't lost any money either. PPG for the materials. Again, Southern Copper is doing way better than these guys. Triple M for industrials. Again, not doing so great. I think Paychex is a better deal for us. And then ARE in the real estate, which is really interesting. It's lost quite a bit. Obviously, KIM is the better bet in the real estate sector, but until we can get out of our MPW holding, we're not going to be able to make that move. And then consumer cyclical, Starbucks, which I prefer IPG. We've seen that one show up quite a bit in those Apple portfolios. I think that's a better bet in the consumer cyclical. So I think, one, two companies. No, yeah, yeah. So we're holding two companies out of the 11 that are in that standard deviation portfolio. So, you know, it's not about mimicking the portfolio exactly, but it is about getting as close to it as possible. And I'm happy with where we are currently. I don't think. Oh, I do want to take a look at this. This is always fun. So, this is the 50-day moving average for the market. And this is starting to turn into something that we can actually look at and get some type of information from. So the lowest was December of last year, right? And this is where we are in December of this year. And so something tells me that that's going to be kind of the case, right? And this is more recent. Again, just really up and down. If I had to draw some type of trend line, and of course we can do that mathematically. I don't think there's a need to. I mean, it looks straight across, like it hasn't gone anywhere. You know, just a lot of ups and downs. And then the 200-day, however, is definitely trending down. No question about it. Even when you look at the 200-day in December, you see that it was, you know, far down relative to everywhere else. You know, I mean, if we were, you know, back here in February of it was 2021, I look at that December low and I think, man, that was a real low, right? But then, you know, we have July, August, September of this year, and we've gotten much lower. And December of this year is even lower. And so I think that's going to continue. I'm not sure what's going to bring us out of this, other than again the Fed to stop tightening. You know, once the Fed stops tightening, maybe we start to see some sort of excitement. But my worry is that when the Fed decides to stop tightening, maybe they stop tightening because the economy is not doing as well as they like it to do. And that has an effect on market sentiment, of course. I don't think that's the case though. It's really hard right now to believe that we're in this downward spiral that this 200-day chart seems to put us in. The employment rate is still good. People still have money. I think the sentiment, right, people's thoughts about what the future may look like, I think is definitely on a downward spiral. But I think the reality is we're not doing bad at all. And at some point, that's going to come to fruition. How long that's going to take, I don't know. But I think we're going to be looking at least another 2 quarters of reports before anyone decides to change their mind. So, you know, that's, you know, almost 5 or 6 months away. That puts us in summer of 2023. Who knows? We'll see. You know, if the Fed tightens again in February or March, I think we'll continue to have this kind of downward trend. But as we saw this past month, you know, if they don't tighten as much, meaning that they decide to raise 0.25% versus 0.5%, I think the market will see that as a good thing, and we'll see a jump in stock prices. But until, you know, we have no tightening at all, well, I think we have the exuberance and the zeal that we had for the market over the last year, and we'll start to see that 200-day start to tick up. Another thing I wanted to mention is that having the 200-day get down as far as it is also a good thing, because as stock prices start to creep back up, it's going to be much easier to get above the historical 200-day. And again, not only for sentiment, but statistically, that's going to bode well for the stock market as well, and all of those alpha stocks that we looked at. Yeah, so we had the death cross back in October. It stayed low in November, and now we have the 50-day getting above the 200-day. And so, if that continues, then we can really see a rally in the market. If not, maybe we fall back below. We do another death cross, which is definitely possible. We could be much lower for much longer. Um, but so far, so good. We got a small one here in June, May. March was one, February, January was one, December. So yeah, so we've been seeing this off and on, October. So we've been seeing this off and on. Um, and so we'll see what happens. Like I said, I think right now it's definitely going to be just up and down, up and down. Um, but if we get any sort of sustained um, growth in this difference here, then I think we'll be looking up. Sure.